Hi everyone and welcome back to my channel. Today we're diving into a topic that often seems shrouded in mystery. Stocks and how the stock market works. I've noticed that many people feel intimidated by the stock market. They think it's too complex, too risky, or only for the wealthy. But here's the thing. Understanding stocks is crucial for building long-term wealth, and it's not as complicated as you might think. As an economist with over a decade of experience, I'm here to challenge that belief. I'm going to show you that anyone can understand the basics of stocks and start investing regardless of their background or how much money they have. I'm going to break it all down in a way that's easy to understand and actually applicable to real life. Let's face it, most of us don't have the time or energy to wade through complicated financial jargon after a long day at work or looking after the kids. I know I certainly don't. So, let's get started. Now, what exactly is a stock? Well, think of it like this. When you buy a stock, you're basically buying a tiny piece of a company. It's like you're getting a slice of really big pie, but instead of it being apple or cherry, it's a business pie. Sounds a bit odd, I know, but stick with me here. Let's say a company has 1,000 shares and you buy 10 of them. Congratulations, you now own 1% of that company, which is really cool. But here's where it gets interesting. By owning stocks, you're not just collecting fancy pieces of paper or, these days, digital certificates. You're actually participating in something economists call capital allocation. Don't worry, it's not as complicated as it sounds. Essentially, when you buy a stock, you're voting with your money on which companies you think will be successful and contribute to economic growth. It's like you're saying, I believe in this company and in what it's doing, and I want to be part of it. Now, I know some of you might be thinking, okay, that's all well and good, but how do I actually start investing in stocks? Don't worry, we'll get to that. But first, let's talk about how companies start selling stocks in the first place. And it's actually a pretty interesting process. So, how do companies start selling stocks? Well, it's through something called an initial public offering, or IPO. Think of it like a company's big debut on the stock market stage. It's when a private company decides to go public and sell pieces of itself to, well, the public. Now, you might be wondering, why would a company do this? Great question. There are a few reasons. They might need to raise money for expansion. Maybe they want to open new stores or develop new products. They could want to pay off debt. Or maybe they want to fund research and development. Perhaps they want to come up with the next big thing. From an economic perspective, putting my economist hat on, IPOs play a crucial role in how resources are allocated in our economy. They allow money to flow from investors like you and me to companies that look like they have promising futures. Okay, so now we know what stocks are and how companies start selling them. But how does the actual trading work? Well, it's not like we're all standing in a big room shouting buy, sell at each other, although that did used to happen. These days, most stock trading happens electronically. There are places called stock exchanges, like the London Stock Exchange or the New York Stock Exchange, where stocks are bought and sold. But don't worry, you don't have to go there in person. You can trade stocks online, often with just a few clicks on your phone or computer. Now, here's where it gets interesting. The price of a stock isn't set by some guy in a suit saying, I think this stock should sell for £10 today. It's actually all about supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. It's a bit like a really fast-paced auction. So, what makes people want to buy or sell stocks? Well, there are a few key reasons. Company performance being one of them. If a company is doing well, making lots of money and growing, people generally want to buy its stock. If it's struggling, people might want to sell. Economic conditions is another. Things like interest rates, inflation, and overall economic growth can affect stock prices. For example, if interest rates go up, some people might decide to put their money in savings accounts instead of stocks. Industry trends is another. Sometimes whole industries can go up or down together. Remember when tech stocks were all the rage in the late 90s, for example? Investor sentiment is another reason. Now, this is a fancy way of saying how people feel about the stock market. Sometimes prices move just because investors are feeling optimistic or pessimistic. And finally, news and events. Big news events, whether they're about a specific company or the whole economy, can cause stock prices to move. Now, you might be thinking, okay, this all sounds very complicated. Why do people bother with stocks at all? Well, there are two main reasons. The first reason being capital appreciation. This is just a fancy way of saying people hope the stock price will go up over time. Buy low, sell high. That's the goal. And the second reason is dividends. Some companies share their profits with stockholders by paying dividends. It's like getting a little bonus just for owning the stock. Over the long term, stocks have historically provided higher returns than many other types of investments. But remember, that's over the long term. In the short term, stock prices can go up and down a lot. Now, I can't forget to talk about the risks. Investing in stocks isn't like putting your money in a savings account. There's always a chance you could lose money. Stock prices can be really volatile, and that means that they can go up and down a lot, sometimes very quickly. It's a bit like a roller coaster. Some people love the excitement, but it can be scary too. Let me give you an example. Let's say you invest £1,000 in a company's stock. The company releases its quarterly earnings report and it's not as good as people expected. The stock price might drop 10% in a single day. Suddenly, your £1,000 investment is worth £900, and that could be pretty nerve-wracking. Or imagine a scenario where there's a global economic crisis. We've seen this happen before, like in 2008 or during the COVID-19 pandemic. During these times, stock markets can drop significantly. Your investments could lose a substantial amount of value, at least on paper. That's why diversification is so important. Now, diversification basically means don't put all your eggs in one basket. If you invest in lots of different stocks, or even better, in things other than just stocks, you're spreading out your risk. Think about it this way. If you only own stock in one company and that company goes bankrupt, you could lose all your investment. But if you own stocks in 100 different companies and one goes bankrupt, you've only lost a small portion of your investment. Another risk to consider is your own emotions. It's easy to get caught up in the excitement when stock prices are going up and panic when they're going down. This can lead to buying high and selling low. Exactly the opposite of what you want to do. That's why it's crucial to have a long-term perspective when investing in stocks. Day-to-day or even month-to-month fluctuations don't matter as much if you're investing for 10, 20 or 30 years down the road. So, how do you actually start investing in stocks? Well, these days it's pretty easy. There are lots of apps and websites where you can buy and sell stocks with just a few clicks. But before you dive in, here are a few things to consider. Educate yourself. Keep learning about investing, which is exactly what you're doing now. Read books and follow reputable financial news sources when you can. Start small. You don't need a lot of money to start. Many platforms let you start with just a few pounds. In fact, starting small is a great way to learn without risking too much money. Consider index funds. These are like a pre-made basket of stocks. They can be a good way to get started without having to pick individual stocks. Index funds give you instant diversification and typically have lower fees than actively managed funds. Think long term. Try not to panic if stock prices go down in the short term. Remember, historically, the stock market has gone up over long periods. Warren Buffett, one of the most successful investors ever, once said, "The stock market is a device for transferring money from the impatient to the patient. Only invest what you can afford to lose. Never invest money you might need for essential expenses." A good rule of thumb is to have an emergency fund covering 3 to 6 months of expenses before you start investing in stocks. Regularly review and rebalance. As time goes on, some of your investments might grow more than others, throwing your portfolio out of balance. Periodically reviewing and rebalancing helps maintain your desired level of risk. Consider your risk tolerance. Everyone's different when it comes to how much risk they're comfortable with. Be honest with yourself about how you'd feel if your investments lost value. This can help you decide how much of your money to put in stocks versus other, say, less risky investments. All right, let's wrap this up. We've covered a lot today: what stocks are, how they're traded, why prices change, the risks involved, and how to start investing. I hope this has helped demystify the stock market a bit for you. Remember, investing in stocks can be a great way to grow your wealth over time, but it's not without risks. Always do your research. Start small and never invest more than you can afford to lose. If you found this helpful, please give the video a thumbs up and subscribe for more chats about money and economics. Thanks for watching, and I'll see you in the next video.